Stock market update. Dow, S&P 500 fall, Nasdaq rises amid Fed rate decision. Brace yourself. The stock market is sending mixed signals, and the calm might be more deceptive than you think. On July 30th, 2025, the Dow and S&P 500 both slipped, while the Nasdaq managed to climb higher. All eyes are on the Federal Reserve's upcoming interest rate decision. But that's not the only thing stirring the pot. Major players like Sarepta, Microsoft, Meta, and Nvidia are also making waves. But here's where it gets controversial. Despite a looming deadline for new U.S. tariffs set to hit in just 2 days. Trump Tariffs 2025, the end of the taco trade and market impact. The powerful message here is that the markets are once again questioning whether the so-called taco trade can be trusted this time around. If you're familiar with the taco trade, an investment approach based on the idea that traders buy stocks expecting Trump will back down on tariffs, then you'll understand why recent developments are so surprising. But here's where it gets controversial. Recent actions by President Donald Trump suggest that relying on the previous assumption might no longer be safe. On August 1st, Trump stood firm on his tariff deadline, signing into law measures that were more aggressive than many had anticipated. The stock markets responded sharply with significant declines observed during Friday's trading session. While the new tariffs aren't set to take effect until August 7th, giving countries some window to negotiate, the market mood has shifted dramatically. Trump also indicated that he remains open to future trade deals, but that doesn't seem to reassure investors, who are now realizing that the so-called taco trade, buying stocks based on the expectation that Trump will back down, may be finished for now. Sounding the alarm, Michael Brown, a senior research strategist at Pepperstone, explained that the recent sell-off indicates that the markets are losing confidence in the idea that Trump will always back down from escalating trade tensions. Meanwhile, Art Hogan, the chief market strategist at B. Riley Wealth Management, added that the latest tariff levels are actually higher than previously thought, which means the trade landscape might be even more intense than investors believed. Part of this shift in attitude is due to how complacent many investors have become about the effects of tariffs over recent months. After Trump announced broad tariff plans in early April, he initially set a deadline for negotiations on July 9th, then extended it to August 1st. Investors had started to believe that Trump might soften his stance to keep markets happy, but mounting evidence suggests that's no longer the case. Brown suggested that Trump might have been emboldened by the fact that markets kept calm despite his trade sabers rattling, making him more willing to push the envelope further. Some experts had already warned this would happen. They argued that if markets didn't react strongly to Trump's aggressive trade policies, he might interpret that as a green light to go even further. For example, GMO's co-head of asset allocation pointed out that without financial market pushback, Trump has little incentive to dial back his efforts. Initially, many investors projected the tariffs would resemble a more modest trade deal, similar to the one the U.S. has with the U.K., which imposes a 10% tariff on most goods, but Trump's updated list includes tariffs from 10% up to 41%, affecting countries like Switzerland and Brazil, with higher duties than he first suggested. This realization is leading many to recalibrate their expectations, as Hogan pointed out. Markets are just starting to grasp this new, more intense reality. Brown also noted that the moment Trump actually implemented the tariffs, following through on his threats, dealt a blow to the bullish narrative that some traders had relied on. The question now is, where do stocks go from here? Spencer Platt Getty Images highlighted that these tariffs come amid other economic challenges. For example, the markets tend to be weaker in late summer, August, and September, adding seasonal pressure to already tense trade negotiations. Additionally, ongoing uncertainty persists about trade agreements, particularly with major partners like China, and some of the economic damage from tariffs is already visible. Recent data shows that July's job creation in the U.S. was weaker than expected, with revisions to earlier months' figures suggesting that tariffs may be weighing on economic growth. Despite these hurdles, both Hogan and Brown remain somewhat optimistic about the stock market's broader outlook for the remainder of the year. They believe the U.S. will still make progress on negotiations, especially since Trump has indicated ongoing discussions with multiple countries. Earlier in the week, Trump shared on Truth Social that negotiations are ongoing and that many leaders are eager to reach agreements that make the U.S. happy, a statement that keeps the door open for potential positive developments. Brown speculates that the deadline for the U.S.-China trade deal will probably be extended, though uncertainty remains high. Still, with strong underlying market fundamentals, Hogan is confident that the S&P 500 could reach around 6,500 by the end of the year, implying modest gains despite recent turbulence. Brown, meanwhile, maintains a cautiously bullish stance. He suggests that the recent market decline might have been an overreaction, and of course, the overall trend remains tilted toward higher stocks in the medium term. The big question: is the end of the taco trade truly in sight, or are we just witnessing a temporary setback? What do you think? Are markets overreacting, or is this the beginning of a more prolonged downturn driven by trade tensions? Feel free to share your thoughts. This debate is far from settled.